If you're managing your own investments, I want to show you something that might give you pause. From 2002 to 2021, the S&P 500 delivered a 9.5% annualized return. Not too shabby. A balanced 60-40 portfolio, 60% stocks, 40% bonds, 7.4%. The average investor, just 3.6% per year. That's almost 6% less than the S&P 500, almost 4% below a vanilla 60-40 portfolio. That is the difference between financial independence and falling short. In this episode, I'm going to break down why the DIY do-it-yourself investors consistently underperform, the behavioral traps that sabotage performance, and how professionals avoid those. So to start off, let's take a peek at the numbers. According to JP Morgan, from 2002 through 2021, REITs topped the charts with over an 11% annualized return. The S&P 500 came in at 9.5%. That simple 60-40 portfolio, 7.4%. The average investor, just 3.6%, which is only, if you look at this chart, 1.4% ahead of inflation. I mean, they barely outperformed cash, which would have led to 0 sleepless nights. So the issue here is the underperformance that we're looking at. It's not just unfortunate, it's actually compounding failure over the course of 20 years. That little gap or big gap every single year becomes massive as it compounds. So why does the average investor dramatically underperform the stock market? Let's break it all down. The first reason is behavioral finance errors, loss aversion, the fear of missing out, FOMO, anchoring, herding, confirmation bias. We've covered all this in another video. Investors tend to panic sell when they should hold or actually buy great companies on sale at a discount. And what else do? They chase hot sectors after the run has already happened. It's fear of missing out. I mean, how many investors, if you think about it, who missed out on NVIDIA when it was $149 at the beginning of 2025, were sitting there kicking themselves? Well, just a few weeks later, it dropped below 100. My guess is that they did not buy it. And that's because when it did hit 100 or 90, fear set in. What happened after it hit 190? Just a few weeks later, NVIDIA was once again approaching all-time highs. So behavioral mistakes, they're not random, they're predictable, and they're costly. The second issue is market timing attempts. Investors pull money out after downturns, they sell low, and then they miss the rebound. They wait for that perfect re-entry point that never comes. If you look over the course of the last 20 years, 7 of the 10 best days in the stock market over the last 20 years, they occurred within 2 weeks of the 10 worst days. Now, if after those 10 worst days you bailed and you sold out of the market, you missed 7 of the 10 best days in the stock market. If you were fully invested from 2005 through 2024, and we're just talking about being invested in the S&P 500, you earned an annualized return of 10.4%. If you missed the 10 best days, your annualized return drops all the way to 6.1%. Imagine if you had 500 grand or $1 million invested in 2005. 20 years later, if you earned a return that was 4.3% lower on an annualized basis, imagine how much wealth you lost out on. And the third thing is lack of discipline. I mean, most DIY investors, they don't have a consistent investment process. They don't have a clear asset allocation or rebalancing strategy. Most DIY investors, they don't know when they should buy. They're sitting there wondering, I want to buy NVIDIA. When should I buy it? What would cause me to sell it? When should I sell it? If it goes up, should I trim? If it goes down, should I buy more? Or should I exit the position completely? They don't have that strategy in advance. Another question they might have is, can I own all tech? I hear AI is the next great thing. Should I own all tech stocks, all AI stocks? Or should I diversify across sectors? So the issue is they treat investing like a hobby instead of as a system. And the fourth thing is DIY investors, they don't have enough time. I do this for a living, full time. I've got a team of dozens and dozens of people working here. And we've got research firms on retainer that employ dozens or hundreds of people, all helping us to arrive at the best decisions. DIY investors, they're doing this part-time. At most, it's a passion or a hobby that has become a side hustle. They're also full-time business owners, parents, professionals, executives, whatever it might be. They have a full-time gig outside of trying to manage their investments as a side hustle. So the question is, do you really want another full-time job while you're working? Do you really want another full-time job after you retire? Because now you're sitting there watching all the business news networks and trying to figure out what you should buy, what you should sell. Or would you rather enjoy the fruits of your labor? Would you rather pursue your interests, your hobbies, your passions, enjoy your family? So look, it's not a lack of intelligence. It's a lack of bandwidth. There's just not the time. There's not the capacity to do what needs to be done at the highest level possible. All right, so let's talk about what professional investors do differently. Why do the high net worth clients of financial professionals tend to outperform over time? Number one, professional investors have a disciplined investment process where they're strategically allocating across asset classes. They're rebalancing on a regular basis. They're making buy decisions, sell decisions based on rules and price levels, not emotion. It is a disciplined process. As an example, our firm, Strategic Wealth Partners, what we do is when we are looking at managing investments for our clients, so we start off with macro analysis. Okay, we're trying to identify fiscal policy, monetary policy, U.S. politics, geopolitics. That's going to help us to identify the best asset allocation. How much money do we want in large cap stocks, small cap stocks, bonds, private alternatives? And it's also going to help us to dial in on our sector weightings. Which sectors, healthcare, tech, consumer staples, consumer discretionary, do we want to be overweight, neutral, or underweight? After we've done that, then we move into fundamental analysis, which is where we look at individual companies. And very simply, what we try to determine is really three things we look at for each company. Number one, the quality of their management team. Do they have a great C-suite where there's no revolving door, where they have a track record of executing? Second thing we look at is their growth story. Is it interesting? Is it sustainable? And do we believe that they have the ability to grow earnings faster than the broader market over the course of the next 3 to 5 years and beyond? And then the third thing is valuation or price, because price matters. And we never, ever want to overpay for anything. I don't care if it's skyrocketing. I don't care if it's going to the moon like those Reddit, Wall Street bets, meme, GameStop, AMC stocks. We want to invest in sustainable businesses that are not overpriced. The second thing professional investors do is they stay invested, right? Advisors, they coach clients through volatility. Wealth management firms are tracking long-term plans, not your daily or weekly plans, not your daily headlines. They're trying to work on ensuring that mistakes are not made, that you don't exit a position after a terrible day only to find out that you missed one of the best days 2 to 3 days later or 2 weeks later. You want to remain invested. Now, remaining invested does not mean doing nothing. There are going to be times where we rotate from more growth-oriented cyclical stocks into more defensive names. There's also times where we decide we want to rotate out of defensive names on a big pullback and into those growthier names because they're going to rebound faster on the way back. So staying invested does not mean doing nothing. It actually means you should be very active, but you don't want to completely exit the market and go to cash. Next thing is they act based on research, not reactions. The pros don't get spooked by headlines. They're probably not watching the financial news networks. They might have a Bloomberg terminal on their computer. They might have FactSet or Thomson Reuters. They've got their machines. But, research is all about using data, fundamentals, and historical context. And what I can tell you is, the big difference between a professional investor and a DIY investor is the DIY investor, if they want to do research, they've got to use the whole Google universe. Like, that is a huge place to start. We, on the other hand, we've got about a dozen different research firms on retainer, hedge funds, investment advisory firms, all kinds of firms that provide us with daily research. We probably get 100 pages of research a day. We can read that. We can actually work off of that to help us to implement the best possible decisions for every single one of our clients. And the last thing professional investors do is they help clients avoid their own worst instincts. I mean, the best advisors are essentially half portfolio manager, half behavioral psychologist, trying to coach your clients when they are fearful, right? Trying to coach your clients when they're greedy. I mean, there's a lot of stocks out there that I know clients have reached out to us wanting to buy that were they were momentum stocks. They'd gone up very quickly, but the price didn't make sense. Unfortunately, we were able to talk them out of those situations. And I will tell you, professionals are going to be much better at avoiding the big mistakes than the average investor. So let's figure out who should do it yourself and who shouldn't. Now, let's be fair. I mean, DIY investing, it's not for everyone, but it can work for some people. And in my opinion, DIY investing can work if you have ample time, if you're willing to dedicate 40 hours a week to really learning the markets, understanding them, understanding the economy, all that stuff. If you have the temperament and you enjoy it, enjoying it's important. You have to really enjoy it to be good at it. And if you have a clear strategy and you stick to it, and it can be a fundamental analysis strategy, it can be charting, technical analysis, whatever that you must have a strategy and you must stick to it. But for most people, you're probably better off working with a disciplined, objective advisor, somebody who can actually keep you on track when the market's testing your patience and continue to make disciplined decisions day in, day out, when to buy, when to sell, when to trim profits, when to cut your losses, when to move on. All of those things add up over time. If this episode made you realize that you've been underperforming, and maybe it's not because of your investments, but maybe your decisions, your lack of time, your lack of access to quality research, hit the subscribe button, like the video. Every single week I cover how the ultra wealthy actually invest, how they avoid mistakes, how they build lasting wealth, and I share these secrets with everybody. And if you want help building a disciplined, behavior-proof investment process that protects your portfolio from emotional mistakes, drop me a comment or DM me the word plan and I'll reach out. Or furthermore, one of the best things you might be able to do is go to my website, portfolioxray.com. Enter your top 10 holdings that you have, and I will get back to you with a customized report that provides you feedback with all 10 of those positions so you can see right now, very quickly, how you're doing.